Alright folks, I think we are ready to get started. We are using a piece of software that I have developed over the last 12 years now. So this baby's got a lot of research and development gone into it. It's vastly new and improved for 2014. You're holding a piece of state-of-the-art software in your hands on your computer there, and it's even going to get better. I'm going to talk about the new stuff coming in the next update. This is the Stock Pivot Trade Analyzer. What it allows you to do is maintain a watch list of your favorite stocks, ETFs, that type of thing. Actually, you can break it down into 5 separate watch lists, and every day run your analysis on those stocks and get precision buy and sell signals, as well as stop placement and a bunch of other good information. The software utilizes logic based off of the pivot highs and the pivot lows, just so that we're on the same page going forward. Let's just talk about what that is. Most people know what a pivot high and a pivot low is. Sometimes it's referred to as the swing low, swing high, and that's basically a day or a price bar that pokes down and it ends up being the lowest low in the series. So the previous lows are higher, the following lows are higher. It pokes down like a little needle. Pivot high is just the opposite. It's the highest high of the series, like a little antenna that sticks up. So we got the previous highs are lower and the succeeding highs are lower. These end up being really meaningful. A little experiment that you can do is you can take any stock chart and you can print it out, and you can sit back on your sofa with a little marker and just find these pivot highs and these pivot lows, and you're going to be surprised at how meaningful they are as far as price reversals. They end up being harbingers of price change. Now, not every pivot high or pivot low is created equal, and that's something I only discovered over the last couple of years in my research, that there is a way to qualify the good ones and weed out the bad ones. Okay, and that's what the software does for you. The latest version of this software that we just released in 2014 utilizes the pivot days for all of the trading setups. So it finds pivots, it qualifies the good ones, weeds out the bad ones, and then it develops a trading signal off of that. The software does a bunch of stuff for you. It's going to give you the trend direction based on my logic of what I consider a trend for the swing trading time frame. You're going to get uptrend, downtrend, or neutral. You're going to know where the pivot highs and the pivot lows are in relationship to the recent price action. You're going to get entry signals, and you're going to get the suggested stop placement. Okay, that's all computed out, analyzed, and given to you in the software automatically. This is an end-of-day system, so basically when the market closes, you run it on your favorite watch list of stocks, and it does all the number crunching for you. The software does, with this latest update that we just did a few weeks back, the 2.1 upgrade, we now have these 3 trading setup scenarios. We have the shallow pullback, the deep pullback, and the super deep pullback, and we kind of went over those in the previous training, and I've got that stuff in the videos. So the software basically can pick off whatever your stock is doing. It is able to find a setup for it eventually. Once you run your analysis and you get your list of trading alerts, you can print those out. Okay, you can select the stocks you want or a specific watch list, and then you can send that to a printer. The other new feature that came out the last version, which everybody is liking a lot, is the export to spreadsheet function. Got a new update planned. It's going to have 2 really great new features that you folks are going to love. One is a new trade management tool. It's going to have its own screen, and that is going to be for the trades that you actually take. And then every day when you run your analysis, it's going to give you suggested stop movement and price targets on that particular stock you're in. The other big news is we have a brand new signal, which we're calling the Convergence breakout signal, and it catches some amazing entry points, and I'm going to give you an example here in a minute in today's training. Now let's just review the core trading goal. As a swing trader, a day trader, our goal as a trader is to position ourselves in a stock at just the right time so that the trade moves in our favor as quickly as possible. Okay? The reason we want to do that is because we don't want to take drawdowns. In other words, we don't want any stock position to go against us too far, because that presents us with a big dilemma. The dilemma of, do we hold on to it and cross our fingers and hope, or do we cash out with a loss and take a loss? So the sloppier your entries, the more you put yourself in jeopardy for that type of a dilemma. Okay, and so that's what this stock pivot trade analyzer software is all about. What the software is going to do for you is the software is going to, when it finds a setup, it's going to generate a price to watch. Okay, so you can see it here, this example here. You can plot a line on your chart. You want to think of this as the line in the sand, or a trade price barrier, or a trigger line. All those phrases work. And you don't want to take a trade unless you see that stock price trying to break through that trigger line. Alright? So what that means is, if you're running the software, and the software doesn't see any kind of setup, it's just going to be blank, which means you just don't do anything. You're not going to get any alerts. So the first big benefit of the software is that it puts some control on you, and when you run your analysis every night, and if you're not getting an alert, then there's nothing to trade. When you do get an alert, you're going to get this price to watch, and then you can go to your chart and plot a line, a horizontal line on your chart, and that is your trigger line. Now in swing trading, what we want to do then, once we get a trigger and we get into a trade, we need to know where to put the stop. Stops are a necessary evil. Alright, they're not perfect. Sometimes you get stopped out, and that's going to cost you money. However, they prevent catastrophic loss. If you trade without a stop, you run the risk of letting a trade get against you for various reasons, which I'll give a couple in a minute, and a trade that could have been a $200 stop out, 6 months later it can be a $5,000 drawdown. Alright, so think of, one is a mosquito bite, and the other is you get your legs amputated. Let's talk about the duration of swing trades. Duration of a swing trade can be as little as 2 or 3 days, or as long as 2 or 3 weeks, or even longer. If you've got a position in a stock that's running hot, and it just keeps climbing, and you can trail a stop, then you can hang on to that sucker for quite a while. On average, if you follow some basic kind of trailing stop rules and profit-taking rules, you're going to find that over the series, your average swing trade ends up being between 5 and 8 days. Today's training is basically going to focus on day trading. I'm going to present you with a way to use how to use the software if you want to do day trading. I call it campaign day trading. Campaign day trading using the stock pivot trade analyzer. Now, before we get started with the details of the strategy, let's just talk a little bit about the pros and the cons of swing trading and day trading. Swing trading, the positives are that you can basically catch bigger moves with less work. If your swing trade is going to last 8 days and you take an entry and maybe 2 days later you sell half and you hold the rest for 8 days, you basically have done like 3 trade executions over an 8-day period, and you can catch a big move. It's a lot less work. You don't need to be at the computer all the time. Once you get a swing trade off the runway, okay, landing gear up, and it's moving away from your entry, all you need to do is trail a stop after market close. You don't even need to do that every single day. That could be every 2 days. You could kind of assess and decide if you want to trail your stop a little bit. Lower commissions, obviously, because you're doing less trades. The negatives with swing trading: you got a little less control because you're maybe not at the computer, so you're not going to be watching intraday movement. And probably the biggie is the overnight risk. There are ways to control the overnight risk in swing trading, and obviously otherwise it wouldn't be profitable. Alright, so let's talk about the day trading. We've got more control on the trades because we're literally just watching them real time. It can be a lot more fun, a lot more intellectually stimulating. I mean, some folks like the action. I do swing trading and I do day trading because mainly I like the action of trading intraday. There is no overnight risk. If you're a true day trader, you close your positions out before the market closes. That's what it means to be a day trader. You can actually get away with larger positions and tighter stops. Why is that? Because we're trading off of intraday time frames. We don't need to take the big wide swath approach of the daily time frame, where we might have a 3% or 4% risk on the trade. We can get down to where it's even less than a 0.5% on the stop. The negatives are it's more work. There's more complexity to it. Okay, we got to be on our game and we got to take lots of entries. We're going to have higher commissions. There's going to be a lot more in and out, and there's more accounting to deal with. Day trading can be very profitable, and again, like I said, it can be very intellectually stimulating. It is fun to day trade. Let's go through an example here. By the way, here is an example of the new trade setup that you're going to get in 3.0 when that comes out. It's called the Convergence breakout. Here's a stock that was made a little move to the upside and then pulled back and then basically gets stuck kind of in a little range here. What the software starts to detect is it starts to detect a convergence, and we've got some logic built into this now that is really fine-tuned, that can pick the exact day where it knows the price is going to break out. Okay, so on this day here, it was 2/4/2014. You can actually go look at your daily stock charts. This is for Adobe. Gave a breakout price to watch long at 59.85. So what you do is you go to your daily chart, you plot a horizontal line, 59.85. If the price can penetrate through that trigger line, you take the trade. You can see that the very next day, the price actually opened below the close, and the next day started to move up through that trigger line where you would have taken your swing trade. Your stop would have went down here, and it never looked back. It just kept on chugging. That's why this is called a convergence breakout. When the price breaks out of this convergence zone, which is based on a bunch of criteria, it tends to take off like a bat out of hell. And then we get this nice big move. In this example here, we had a 14.5% move within an 8-day period. And remember I said your average swing trades tend to last between 5 and 8 days. Now, let's talk about how do we day trade using the recommendations from the software. I started developing this strategy a few years ago, day traded with it for quite a while, refined it. It's a very simplified approach, as you will see, but it works great. Everything that we want to do in trading, whether it's day trading or investing or swing trading, we need reference points to work with. The main reference point that we're going to use in this technique is the previous day's 30-minute closing range. That is going to be one of our key reference points. Day traders use all kinds of stuff, and they're actually big on like the opening price of the stock or the opening range of the first 5 minutes or the opening range of the first hour. Well, I thunk outside the bun and I use the previous day's 30-minute range, and I'm going to show you how cool that is and why it works. You can day trade off of all kinds of different time frames: 60-minute chart, 15-minute chart, 10-minute chart, 5-minute chart. Some people like 1-minute charts. This strategy mainly works pretty good off of the 5 minutes, so I'm going to be showing you how that works. Now, the day you get your signal to go long on your stock, and we're going to use this example that gave us like an 8-day run higher. On your 5-minute chart, you plot your line in the sand, right? That's the trigger line. Here's the here's the close, and here's going to be the opening bell, right? You're going to be a day trader if the stock price can get up into this quadrant here. You're going to sit on your hands if the price stays in this lower quadrant. That's on day one. If the stock opens and trades lower, or you might even see like a gap down, you don't take a trade. One of the problems that day traders have is there's so many different types of setups that you can play off the charts. People want to try to play gap downs or gap ups and all that business, and they think they see all kinds of Fibonacci moves and this and that. And what you can find is you can find yourself over trading, hyper trading, over trading, getting lots of stop outs, and you really are not working with anything solid. You're just basically kind of micromanaging the intraday chart because you think you see these little intraday patterns. What we're doing here is we're going to be basing our day trades off of the potential swing move, which can follow through for 5 to 8 days. Now we got something solid to work with. We know that once we get a signal in the software and the price is able to penetrate that trigger line, now the bias is going to be to the upside for the next couple days. All right, so we're not guessing anymore intraday. We've got something, a solid starting point to work with. This is day one. We're looking for a move above the trigger line. So let's take a look at what happens. The software issued this trigger on this day at the close, 59.85. So we got the line. The very next day, here's the open on the 5-minute time frame. First 5-minute bar, the stock is trading below the trigger line. The second bar penetrates. So within 10 minutes, you can be in a trade there. Typically, your stop will be placed below these couple bars here, and you're going to have, for the most part, really nice tight stops. 0.5%. Those are day trading stops. That allows you to actually take bigger positions. Notice how on this particular example, the first day we basically break that trigger line, and you could in fact get into an entry. This ended up being about a 1% quickie move. Notice when this price pulls back now, where does it pull back to? It pulled back to the trigger line for one, but also to the top of above the previous day's closing range. So we could have looked for another entry in here, and I'm going to talk a little bit about how we refine the entries. So the rule is this: as a day trader, if you're going to do a campaign day trading on a stock after you get a trigger, you only trade, if it's a long entry for instance, you only trade long while the stock's above your trigger line. Alright, so let's see how the day ended up. So you can see here was the close, here was the open, and then we had the stock take off, pulled back. If you did get an entry down here, I'm going to show you how you would have done that, and you hung on till the close, you had a 2% move that day. Now, I'm showing you almost a $60 stock. Different stocks have different average ranges. So if you're playing a stock that has an average range of 10%, maybe it's a $5 stock and it has an average range of 10%, you're going to see much bigger percentages. There are some stocks that can make some amazing gains just in one day, but that's okay. 2% is not bad in a day on a day trade. One thing that day traders do is you can take half off at a certain gain. 1% is not a bad target, and then a lot of times if the day looks good, you just hold into the close. Alright, here's day two. Very next day, notice the stock actually gaps up a little bit, comes back down. Here's the previous day's 30-minute closing range. What's the rule? Only do a day trade long above the previous day's 30-minute closing range. So we meet that criteria here. We pulled back, and you could have taken your initial entry here. Your stop would go down below the previous day's closing range. We get the stock price moving in our favor. It kind of hits a little plateau here. It pulls back a little bit, trades higher. We end up with a flat top, and then this is what I call a flat top breakout. There was another entry point there. Down here above the previous day's closing range to the high was intraday 3%. Now here's what we're doing. We're focusing on stocks that are going to have a strong bias to the upside because they triggered a swing trade. The software gave you the initial trigger point to begin this campaign, right? And then the bias will be to the upside each day to fulfill the swing cycle, which is between 5 and 8 days of moving higher. If it's a swing trade short, you could expect your stock to spend between 5 and 8 days trading lower. Do not take a day trade unless you get setups that are above the previous day's closing range. You don't need to worry about the open. You don't need to worry about the first 30-minute range. It's all dependent on the previous day's range. Day 3. Now here's an example. Here's where day 2 closed. Here's an example where you got the open lower than the previous day's range. Started trading a little bit lower. The rule is no trades unless we're above the closing range. You just basically stay out of this trade until the price can prove to you it's going to break that range. Now, you might say, well, yeah, but I could have got in here and I missed some of that movement. you don't know that it's going to be able to break here. It may run up and hit the midpoint and then take a big winger. We need to have a strict, reference point somewhere, something mechanical that we follow, and we can't be bending the rules all the time, and that's because that's what gets traders into trouble. Now notice in this example how from this point here to the close was another 1.5% move. Every day that goes up in the swing cycle, there isn't a lot of selling going on. It's like your bathtub has got the plug in it, and the water just keeps filling up. Your price just keeps rising each day. Alright, so let's take a look at day 4. Now day 4 was kind of a rest day. So notice what happened here. You have a big gap up at the open. You are above the previous day's closing range, right? However, we like to take our entries in close proximity, at least our initial entry in close proximity to the previous day's range. We would not want to be buying up here. We would instead want to wait for a natural pullback. Interesting here, notice how the stock price pulls back. Where does it pull back to? Pulls right back to the previous day's 30-minute closing range, and that's where it bounces and takes off. Now you could have got a trade here. That ended up being maybe almost a 1% bounce here, but depending on how you played the trade, maybe if you got in, you took half off the table here, held on to the other half, but then basically you got nothing. The stock went flat the rest of the day, and as a day trader, you close your position out before the end of the session. So we could score that as like a 0. Stock just fizzled out, took a rest day basically, didn't do anything. Alright, day 5. Day 5 picks up again. Buyers come back into the situation. We get a quickie move off the open. What do we got here? We got a bullish flag that starts. So here's actually another little entry, and you can see then the stock continues on its merry way. Again, what's happening is, think the bathtub is filling up with water. That's what's going on. That's why you get this gradual climb. A little bit of selling, gradual climb. The buyers are just coming in waves and continue to buy and hold, and that drives the price up into the close. When you've got a stock that's on a tear in the swing trading cycle, and this is another thing where day traders get tripped up a lot. Day traders, since a lot of times they're focusing on these little wiggles throughout the day, they miss out on the fact that your bigger day trading gains many times will occur if you just hold into the close. Why is that? Because what happens is the higher the price that the stock gets, you're going to get these contrarians that come in that are trying to short. They might have tried to short here, they might have tried to short here. They get into short positions, which as you get closer and closer to the close and that short position doesn't work out, they have to get out of those short positions, and when you short, you are automatically a buyer to exit your position. So you create buying pressure. This type of price movement here is not necessarily buyers coming in because they like it the last 5 minutes of the day. It's the shorts trying to get out right before the market closes. They're not going to hold overnight. They blew it on their position, and they're covering like mad, and that spikes the price up into the close. If you understand those kind of mechanics, you'll understand that many of your big day trading gains, stocks that are hot and running nicely, by holding right into the very close. Okay, so here's day 5. Stock keeps going up. We're dealing with a stock that we know has a bias, a strong bias to the upside, because the software picked it, gave us a trigger line for a swing trade, the typical swing trade. So we know this stock is going to be biased to the upside for the next 5 to 8 days, and we can every day, we've got a reference point to know if we should try to trade it. Can and is the price above the previous day's 30-minute range? So we just keep day trading this sucker until it's no longer above the previous day's 30-minute range. You might be able to do a day trading campaign for 12 days straight. That's the nice thing about this strategy. Okay, here's day 6. The sucker just keeps going. Here's an example. Here's the previous day's closing range. You can see that final little spike up bar there that I was saying was probably a short squeeze into the close. The next day we open a little bit lower. You sit on your hands. You do not take action until you breach the high of the previous day's closing range. When you do, there's your first little trigger. Your stop goes down here. That's going to be very tight, 0.5%. Here's your first entry. Thing bolts right out of the gate. Then we go into a little period, that's the little early morning period, the slow period, right? And we get what's called a Slim Jim pattern, okay? Just think of the pepperoni stick from the 7-Eleven, right? And it's sloping up. Okay, this is a very tried and true day trading pattern that we like to use. The top, and here's the subtle things that make this a really good setup. The top, we like the top to be flat if it is. It doesn't have to be, but when we see the flat top, see how nice and flat that is? But look at the lows. The lows are sloping up. That ends up being a bullish wedge, bullish Slim Jim pattern, right? And so what's happening here is there's a lot of subtle buying going on here, and there's less and less selling, which is why the lows keep getting higher, and eventually that sucker just erupts. Guess what? It's like pouring lighter fluid on a campfire, because when we start to break out, all of us day traders jump on this sucker, right? And we drive this sucker higher. If anybody's trying to short this, they got their stops here, so they cover and they get turned into buying pressure, and this thing takes another little elevator ride up. Same thing, spike into the close. That's not buyers, that's the shorts saying, I screwed up again, I'm out of here, I got to buy and cover and get out of this sucker. Alright, so nice pattern. This one was a 3% intraday move from the top of the previous day's range to the close. So far, so good. Alright, this is a campaign. Every day we can wake up and we know we've got a stock that's got a bias to the upside because it's in the swing cycle to the upside. The software gave us the initial trigger, and we can just play this reference point every day. Okay, now this is some powerful stuff that I'm teaching you, and the cool thing is it gets you away from, again, the day trader's trap, which is trying to trade too many different types of patterns that they think they see on stocks that really aren't primed to make a move one way or the other. And you end up, getting what's called the, death from 1,000 cuts. You keep just getting stopped out, because you're trying to play meaningless wiggles. Here what we're doing is we've got a stock that we know is biased to the upside, and we know the buying pressure is there, and we know it's going to last 3 days, 5 days, 8 days or more. And we've got a reference point. Okay? Very powerful strategy, very straightforward. Okay, next day, day 7. Day 7, a little bit slower of a day, but here's what goes on. We are above the previous day's range, closing range. Kind of popped up a little bit. We came back down. You could have taken an entry there on this kind of bounce. Remember the rule. We want to buy, we want to get long above the previous day's range, preferably in close proximity. So there was an entry point. You can see the stock started to clang around and move. Then we had a flat top breakout. You see that nice clean flat top. There would have been another little place you could have done an add-on, and then again into the close, 1.9%. Now when you do this strategy and you analyze some of these stocks, these lower price stocks for instance, that are really high octane, you're going to be seeing much bigger intraday gains. You're going to be seeing 5% moves, 8% moves, sometimes 10% moves. It gets crazy. But I wanted to just pick a normal old stock like Adobe, $50, $60 stock, to show you that even On an expensive stock like that, we're getting decent intraday moves. Alright, day 8. The campaign continues. Day 8, we come in here and notice what we get. We do get a breakout above, quickly on, but then we quickly kerplunk. I'm going to show you why we would not have taken a trade there. I mean, you might have taken a trade on that first breakout, and you got a little bit of a move there, so you might have been able to, anytime you get a move in your favor, you want to either pull some off the table or adjust your stop a little bit. We don't like, if you can help it, we don't like to ever let trades go into the negative on us. So let's say on this example here, even if I took this trade and got this quick pop, I probably would not have let it go all the way back down against me like this. All right, I would have let myself get knocked out, break even here, and just re-entered if we moved back up. But even if you didn't, again, it's a 0.5% stop out probably down to here. Not a big deal. Now notice what happened then. The price move fizzled. We got trapped in the previous day's 30-minute range, closing range, and basically we were suppressed all day long. Only later did we try to break out. You could have played that, and then that fizzled, so you would have had to close that out into the close. So you might have taken some hits, small hits on this day, or you might not have even taken trades just because of the action. Here's like one of our final days of the campaign. This is a nice thing about this technique, this strategy, is because we know when it's over. There's no guesswork. It's like, well, how long do we keep doing this? When do we know when to stop? When the price can no longer trade above the previous day's closing range. Notice here, campaign over. This is the previous day. It opens, and then what does it do? Instead of breaking to the upside, it starts breaking to the downside. Okay, now we're trading below the previous range. The main thing is, you see how the software helped find the initial starting point, and it helped find a stock that we knew was going to start a new swing cycle and give us a good 5 to 8 days of bias to the upside. And then the strategy gives us the reference point to work with. Okay? That's it. It's that simple. Now, I'm going to show you one other little trick. You'll want to put this on your charts here. When we're trying to fine-tune our entries, what we want to do is we want to use the 8-period SMA on the 5-minute. So 8-period simple moving average, and your entry rule is this. When we meet the other criteria, let's say we're above our trigger line, or we're above our previous day's closing 30-minute range, we want to buy on breakouts above an overhead resistance line, and we also want to always buy above the 8-period. If you follow those two rules, it'll keep you from buying when you don't want to be buying. Okay? What happens is people look at a chart like this and they'll go, oh, I want to get in here because it's better. It's cheaper. I'm getting in at a better price. Well, that's great, but what if the stock price just keeps on chugging lower? Okay, then it's not so great. It's better to let the stock price, the momentum of the actual price, trigger you in. All right, we already know we've got upward bias because we're going up in the swing cycle. We're following the rules on the reference points. Now we got one final way to fine-tune things, which is only take your entries above a overhead resistance line break, and your entry price should always be above your 8-period. Even if you have all that other criteria, this will fine-tune things and keep you out of trades that could go bad. All right, you can see here in this example over on the right, I've got my overhead resistance line, and we are trading below an 8, so there is no entry. Even if for some reason we think, hey, this looks like we could go up from here, you don't pull the trigger. You wait for the break and you wait for the move above the 8 period.
Welcome to Stock Pivot Trade Analyzer. Stock Pivot Trade Analysis complete.